I must admit, slightly sidetracked this morning. Probably the most volatile morning I've ever seen in a good 10 and a half years of watching the markets that I've ever seen on a non-farmers morning. Normally you can literally put your head on the desk and have a snooze from the beers from the night before on a non-farmers morning, but complete opposite this morning. That seemingly has died down slightly, which I would have expected, but certainly cable still at 123.57 it's held on to about, I'd say, 50% of that initial move that we had this morning, and certainly could still be in for some fireworks yet to come. I'm trying to think of any scenario that this non-farms could play out, and I really can't see that the data itself alone could push us back down to that actual spike low at 2035, but we'll have to just keep an eye on the dollar movement, because that's going to really take precedence as we await non-farms. So a quick look at non-farms. Going to switch my screen over to the Fed Watch tool by the CME, and so really what you're looking at here, not so much November but December, and the pricing in of the probability of a 25 basis point rate hike. Now here we go, one more draggy comment here, just coming down the wires. QE to run until end of March or longer if needed, sees rates at current or lower level for an extended period. So keep an eye on the euro. Let me just change up here and just take a break from the non-farms look. We've had a couple of draggy comments just come out before I started, but two more there. Very dovish comparative to the hawkish, remember the taper Bloomberg sources we had at the beginning of the week? Yeah, so look at we had a bit of a lift in euro initially, a bit of confusion on the first draggy comments, but these ones here, very much a reiteration. Let me change my charts up. This is very much a reiteration of the existing ECB current stance. QE to run until the end of March or longer if needed. Sees rates at current or lower level for an extended period. So as you can see there, a little bit of a pull down in the euro currency. Just quickly, I was discussing this with peers actually the other night about what's occurred here. And you've had these surprisingly hawkish source comments. And our kind of view is that really I think that the ECB are not serious about tapering, but I think what they've done here is a very clever front running of putting the word taper into the psyche of market participants. Now the cat's out the bag when the time comes to tweak ECB and then ultimately taper at some point in the future. Now the market has a sense of it's desensitized to a certain degree. So when the ECB does want to alter QE, whichever fashion, particularly on the tightening side, then the impact is going to be more manageable because they've already floated the idea in the traders' heads. So I think it's actually quite clever what they've done. They've managed to do it with, albeit when it came out there was a pretty drastic move, but we've kind of leveled since then. And now you get the kind of reiteration of the current stance from Draghi himself. Don't forget, the ECB would have very cleverly and purposefully have used that Bloomberg source. It didn't come out of nowhere. And so now they've tested the water, they've seen how the market reacted, and now Draghi's come back in and just clarified the current state of play. So that's kind of how I see that at the moment. It's the ECB desensitizing the market to these key words that are yet to come in the future. Anyway, back on point, non-farm payrolls. Looking at that Fed funds futures again, 55%. The Bloomberg reading actually is probably a touch higher, more like 60 to 65%. Looking at the federal funds rate futures. So the market, let me have a quick scan. We've had ISM non-manufacturing. That was a 57.1 print above 53. That was a phenomenal reading. You've also had factory orders plus 0.2% against expected minus 0.1. ADP was 154,000, below the expected 166, very minor revision. ISM manufacturing PMI was also higher than expected, 51.5, and expected 50.3. So on the balance of data, we generally have been seeing good numbers coming out of the US. And so one of the main things here is like, how has this been feeding through then into market prices? So kind of first one really to look at is T-notes, because T-notes have seen a quite nice move materialize over the course of the last week or so. You can see here a very clear breakdown that in combination with this good data, you've had continued hawkish Fed commentary, even to the degree that the most outlying members, such as Lacker and Mester, talking about a live November meeting. Certainly something in which the broader market certainly is putting very little belief in, given the timing is a few days either side of the US actual election. And so November's not really in focus. But yields have been rising steadily in the US. If I was to show you a dollar index chart, basically you can just, well, let me just show you. This is the T-note chart. Here you can see that since the really end of September, we've been tracking down quite significantly. The dollar index chart essentially is just the other way round. So it'd be, if it was here on overlaying this graph, it'd just be a giant X. Dollar going up, appreciation with US yields rising, and as such T-note prices falling. Again, the premise being markets have been pricing in further expectations to a higher degree that the rates will rise. The S&P is a little bit more complicated because, and this I think is very important for you guys trading today's event, I would say equities is not the asset you want to be looking at to trade. Now, you can see here I've got T-notes at the bottom on exactly the same time frame as my T-note chart, or T-notes at the bottom, S&P at the top. The S&P really has just chopped about in a range of about 30 points, whereas the T-note has had a nice clear downward trend. What that's telling me is that equity players are a little bit indecisive about what it means, the Fed hiking rates. Is the good data, good US economy able to withstand a hike, and that's net positive equities? Well, that's been the general trend in the very short-term, minute-type reactions post-good data. But overall, we've really failed to sustain any concerted move on the upside because people might start to get a little bit nervous, particularly if November becomes in question. I still think that's very unlikely, but if December starts getting up even higher, then maybe that starts to become a net negative, because then it is really a true reality that rates will go up. At least that's how the market will be positioned. So I think equities may be one to avoid this particular release round. The other one that I think that you should keep an eye on, though, is gold. Because looking at gold on the same time frame, obviously we've had this big collapse in prices earlier this week of that $1,300 handle, and we're down at $1,250, or $1,257 to be precise. What that's saying to me is that, again, this is kind of an interest rate play. Rates going up. Obviously you've had a few other things, good data, hawkish ECB sources early in the week. I don't think that's so much to play. This is more a view, I think, of technically that broke down at 1,300, but persistent dollar strength. There's certainly pressured prices on this Fed view. And so there is plenty of room on the upside, I feel, if you get a poor reading. And by poor, I mean the bottom of today, well, the consensus for today's headline NFP is 175. The bottom of the range is 125. Now, I myself am going for outside of that range. I'm not going to tell you what side, though, because, as you know, we've got a competition going on. But obviously, the size of this move here shows me that the market is positioned in a way in which we're expecting a hike. So the bigger trade here potentially is going to be if we get very weak headline accompanied, and this is important, accompanied by very weak wage growth. If we get also downward revision to the previous and a downward net revision, that's the, for me, it's the Anthony Algo signal that this market could reverse some of these moves that we've seen. So we're going to need a poor headline. When I say poor, it needs to be below the bottom end of the range. I'm talking 120 sub. I'm talking sub 100. If you get sub 100, weak wage numbers, downward revisions, net revision as well, then you might start to see a powerful move to the upside in gold. I think T-notes that could easily spike up certainly I'd be looking at a move, looking at that high from at 12.5 would probably be a reasonable target, but even more so as people start to strip out as such firm expectations of December. Even in that scenario, I'd still say December would probably still remain viable for the Fed, so it'd probably drop from 65% probability down to 50. So it might still be on the balance of being priced in, but certainly the way that this market is priced, where it's so assured of a deck hike, I think it has room for reversal. Now, that means then, if we get a strong report, it means that further downside for T-notes and gold could be seen, sure, but I think that's going to be a more muted reaction. Now, gold's a little bit more interesting because we've obviously defined a bit of a new low here, just above the $50 or 50 mark. I would imagine that 12.50, if that gives way, and certainly it's within sight, then you could see a bit of an extended punch lower, because that's probably a level a lot of people will be looking at. Okay, going back to the actual number itself then, let's have a look at a few other things. You've probably seen this before. I don't want to spend too much time dwelling on this. This is Danske Bank's kind of labour market in one chart. You can see here the red centre circle denoting the situation of the employment sector amongst all these different areas back in 2009. You can obviously see it was a much more smaller circle indicating the severity of that the financial crisis had on the jobs market. You can see here that December 2007 we recovered, and then to where we are at the moment, things are looking quite healthy, other than people working part-time for economic reasons and marginally attached has potentially needs a little bit more of a lift, but overall things are fairly healthy on an employment side of things, I would say. Looking at actual non-farms on a historical basis, the data has been, I think, on average, good enough for the Fed to be in the mindset of hiking. I think rightly so, they should be hawkish on this metric alone, which is the jobs sector. You've had 271, 275, 151, putting us up on a 3-month average that's pretty solid, up at above 240. That's why, for me, really, you've got to see a sub 100 level on the headline print, with the other components being negative, to really, let's say, make the market think twice about the Fed pulling the trigger in deck. A solid number, let's say we print up at 300,000. I mean, what is there really to change in terms of market view? Because ultimately December will just be priced in more fully, but realistically, even if November increases, the Fed are going to find it incredibly difficult to hike rates in November. And even if this was a fantastic report, although we might get some intraday volatility that may be positive in terms of that response to market movement on higher near-term rates, I still think November is off the table in terms of the political risk that could well come up. And let's not forget, the next televised debate is this Sunday between Trump and Clinton. So that kind of really pretty much summarizes the state of play at this present point. As ever with non-farm payrolls, please be careful, new guys, with the initial volatility that you're likely to see in the market. Remember, as with the month 2 guys, I gave a lecture to you earlier this week about trading multiple data releases all at once. This increases the number of variables, which makes it even more difficult to trade. What you're looking for, potentially, is the initial noise, but then taking the report as a summary of then general sentiment to provide a prevailing trend to the market thereafter. Now, this could take a minute, it could take 5 minutes, it could take even half an hour. It just depends, because there's so many variables. They either all need to line up in one direction or the other, which will mean to more conviction and clarity in price movement. But normally what happens is you get one indicator saying this, one that, and one the other. So give it a bit of time. Also as well, the thing the market will react to first and foremost, of course, will be the headline. So be aware of that spike, but just be mindful to listen to the squawk to see whether the wage components in particular match up to the way the headline has come out. If you get a 300,000 headline, fine, dollar spikes and then T-notes spike lower, but then just be careful then if the wage numbers are poor, much worse than expected, you're going to get a full reversal on that move pretty quickly. So again, I urge a bit of caution around the initial noise and then let it play out. In terms of market expectation, again, 175 is your median consensus. The range on the market from major banks is 125 to 220. Depends who you want to believe. Touched upon this earlier in the briefing. Bank of America looking at more the low side. They're looking at August and September historically have surprised to the downside and then been revised higher. Don't forget, non-farms gets revised not once but twice. Whereas Barclays a little bit more bullish. They're looking at 185. BNP Paribas, they're looking at 160. So bit of a spread, and we'll see. Can Sam North hold on to that in-house trophy? What is Sam's guess, please? Going to put him on the spot. The champ gets put on the spot.
210.
Sam North, the current in-house champion, is going for 2010. He is up there. I would say that's a good question. Will's just asked me, what's the trade if it comes in at 210? I would say the trade at 210 is going to be whipsaw price action. I would say that's probably an event which a number that I wouldn't want to really see, because I would say that the market's consensus is at 175, but I'd say we're positioned for a more positive number anyway. So 210, I think you're going to get a more minimal reaction. Then it's about the components all matching up. If you had 210 with absolute forecast beating wage growth numbers, upward revisions on both, then sure, you might get a bit more of an extension on that move. But I think 210 was still within that realm where it's not going to really affect the Fed. And let's not forget, between now and the Fed December meeting, even after this release, there's still 2 more non-farm payrolls to come. So there's plenty to play for between now and then in terms of economic data. Okay, guys, going to leave it at that. You've only got about 7 minutes now, so good luck. I'll be on the mic throughout. Enjoy.